Hey everybody, it's Chuck Malone with Strong Towns. Nice spring day here in Minnesota. I want to talk a little bit about housing. I've been immersed now in the housing conversation since Escaping the Housing Trap came out. And people have been sending me stuff. One thing that I recently got was an article about how in Florida, there are cities now that were dealing with Airbnbs and actually went in and banned them or seriously curtailed them. And then that dramatically dropped prices. And they connected those two things, the city action with a dramatic drop in prices. If it were only so easy. I'm really not convinced. I get the idea and I get the connection, but I want to put forth another idea or another notion because there certainly are reports right now about softening in the housing market. Basically, housing prices starting to now fall. And in some places, particularly in Florida, fall dramatically. A lot of this is correlated in a sense with neighborhoods where there are a lot of Airbnbs. But I think the cause and effect here is a little more interesting than you might think. I don't think it's necessarily that we have banned Airbnbs. I think it might be that we just saturated the market with them. And what you have is you have a situation where the financing model doesn't make sense. There was a report put out by the Federal Reserve, I want to say of St. Louis, but I can't remember. It doesn't really matter. It was one of the branches of the Federal Reserve. It was Pennsylvania. I remember now. They put this report out looking at fraud in the mortgage market. And this is kind of funny because I know a lot of people who do this. It's actually a very common thing. People will go in. Let me be clear. I have not done this. But I know a lot of incremental developers and people who this is a common tool. They go in and they get a mortgage, essentially representing on their mortgage application that this is going to be a residence for them. Sometimes you put your existing house in your wife's name. You'll go out and buy the other house, or spouse can be flipped, vice versa, whatever it is. You go out and you get a house and you represent to the bank that you're actually going to live there, even when you're not. The rigor on this kind of application is very low. And so what happens is you're able to get, in a sense, low rates, low down payment. These things can be sold on a secondary market. They're treated just like a residential mortgage. But when the Federal Reserve of Pennsylvania looked into this, what they saw, and I think quite obvious, is that a lot of people lie on their applications, and the banks really have no incentive or motivation to check this out. Why is this important? It's important because a lot of these places, particularly when you go to a touristy type state like California or Florida, where a lot of these vacation-esque properties are owned by Airbnb, people who are renting them out as Airbnbs or VRBOs or whatever your flavor is. Those are business investments. They have very little capital down. They have very little equity, very little margin. They're based on kind of tight cash flow models. So you are counting on a bit of appreciation. You're also counting on being able to rent it continuously. Anyone who has looked at the hotel and motel industry knows that there's a lot of volatility in that industry. I saw somewhere once there's like a 7-year cycle where there's not enough units, they build, then they overbuild, and there's a collapse, and then it kind of cycles back and forth. It might be longer than that. But the idea is that there's a reaction, counter-reaction kind of thing. The same thing happens in Airbnb markets, right? There's not enough demand, you can make a lot of money, the early people there make a lot of money. Then all of a sudden, there gets to be a lot of them, they're not renting as much. All of a sudden, the marginal players, the people who don't really have as much skin in the game or are too over leveraged, wind up not being able to wait out the rough patches in the market, and they go bad. And the report from the Fed said this is a huge, huge concern because in markets that are, in a sense, overweighted with these fraudulent loans, there are reasons to think that these loans, even though they're rated AA, AAA, have high credit scores, are not going to be around very long. People will walk away from these places very quickly. There's no reason for them to stick around. Hard to say what this effect will be, if it's a national effect. Hang on. Hello. It's hard to say what this effect will be over the long term. It's hard to say, widespread what the impact will be. Certainly what we see is that people who are using residential mortgages to, in a sense, make commercial loans are the marginal buyer in a lot of markets, right? They are the person paying the highest price. They're the market maker. They're the ones that are driving prices up, and everybody else has to compete with them. They have a very different financial model than a family looking to get into a home. So having a little bit more rigor in the mortgage market, getting rid of this fraud, would actually help lower the acceleration of prices. I think the open question, and the thing that I don't quite know, is as prices stagnate and where they start to fall, like we're starting to see in parts of Florida now, will these fraudulent loans, will these kind of over-leveraged commercial products masquerading as conventional residential loans, will that impact a downward spiral? Will it boil over into the financial markets? Will it have an impact on things like mortgage-backed securities, bank deposits and reserves, and all the things that brought about the 2008 crisis? I don't know. I don't think anybody knows, but we will soon find out.